Hello and welcome to House and Home Chat, Real Estate Real Talk with Dena and Chris. I'm Dena Mathes.
And I'm Chris Breitenbach. Hey, we continue to hear in the media that the real estate market is coming to a screeching halt and crashing. Economically, we may or may not be in a recession. And we're hearing that interest rates have risen again. The sky is falling is a consistent message.
Well, Chris, the market definitely has shifted, and that's what we're here to talk about today. But I can assure you on this beautiful sun shining day that the sky is not falling, right?
All right.
Absolutely.
That's what I say.
It's not falling.
That's what Adam says too. And it's always a good time to buy or sell if it's the right time for you. So for some people, the spring and the summer were a good time. For others, the fall and the winter will be a good time to make a move. But with that shifting market, the strategies have definitely changed. And that's why we like to frequently bring our audience, local mortgage experts, to speak to those shifting strategies.
Yeah, so today on our show, we are happy to be chatting with Adam Brewer of Rapid Mortgage.
Yeah.
Adam will share insights into the current mortgage world and lending strategies that as a buyer and a seller, you may see or consider. So Adam, let's begin by having you share just a little bit about yourself.
Yeah, absolutely.
Welcome.
Thank you so much. First of all, thank you both for
You're
inviting
welcome.
us.
We're
Great to have
excited.
Super excited.
Mhm.
So a little bit about me. I have been in Cincinnati for a little over 10 years now. Don't hold it against me. I'm from Pittsburgh.
I was gonna say, where are you
I'm from
going?
Cleveland, so
Where
that's
are you
what it
going
is.
with this? All right.
But no, I am a Bengals fan whenever they're not playing the Steelers. That's how I phrase it. But no, I've been in the mortgage industry for 6 years now. I work at Rapid Mortgage, as you mentioned, locally owned and operated. My office is in Anderson, where I live, and our corporate office is in Blue Ash. Everything we do from start to finish is in-house, so that makes us, kind of quicker and able to handle more situations because we're more flexible. I am married. I have no kids, no pets, but we just finished renovating a house,
Oh,
so
neat.
we're living in that, which is wonderful.
Nice.
My hobbies include, let's see, I love to cook.
Did you do the renovation yourself?
Heck no.
Oh, okay. All right.
I am not that guy.
Okay, gotcha.
I learned that somebody else can screw something up because then my wife will yell at him.
That's smart.
That's smart.
Learned
Very
early.
smart.
Learned early. But yeah, so I love to cook. I love to hang out with friends and family, and I enjoy going to the gym and playing golf and stuff like that.
Awesome.
Well, that is great. Very good. So I'll be picking your brain in the near future for contractors as we go along.
If they're available, they're not good.
It's challenging.
It is.
It's a challenging market in a lot of respects, and it's hard to find good quality workers, isn't it?
And who can get here within the next month.
Yeah.
Or
Yeah.
not year.
So one of the big questions, obviously, we always get, how's the market? And how are the rates?
Yes.
So, in light of the recent, hike in the rates and such, tell our listeners a little bit about where we are in the market as far as the rates go.
For sure. So everybody talks about the Fed now, and before 2 years ago, nobody even knew what the Fed was.
Yeah.
So
Now we're following very
exactly.
closely.
So yes, they did another rate hike this past week of 75 bips or 0.75%. And does it affect mortgages? Yes, but it is not a direct correlation.
Okay.
So you're going to see the sky is falling, the rates are going up again, and it's just going to get worse. Actually, what happened over the last month is the market built in because they were assuming that the rate was going to jump because that's what the Fed said it was going to do.
Right.
So they kind of absorbed that cost. So our rates actually pretty much stayed flat compared to the last rate hike.
Okay.
Okay.
So as of, the mortgage-backed securities rate, which is what we use as the bar for the national mortgage rate,
Right.
is around 7.3 as of when we're recording this, and that can change quickly.
Yeah.
Mhm.
So
That's what we say.
yeah, but that doesn't
Today.
right. That doesn't mean exactly that your rate's going to be 7.3%. So
Okay.
I'm currently seeing roughly around 7.125 is the average rate for a conventional buyer.
Oh, that's
Conventional.
actually a better direction than what I assumed.
Right. Yeah, we fought back a little bit after the last rate hike, so we've
Okay.
lost half of that fight back given
Mhm.
the next hike. So
And that's on a conventional 30-year.
correct, 20% down, perfect buyer kind of situation.
Got it.
Yeah. So what other things, like somebody hears that and they're assuming they're going to get that rate, then they talk to a lender and now all of a sudden it's like 7.5.
Right.
What goes into that? What affects their personal rate?
Yeah,
Let's
so,
call it the personal rate.
right, I like that. That's a great question. So it really comes down to their, like you said, personal rate's going to take into a lot of factors: their down payment, their credit score, the actual loan amount. We're talking conventional, so that's their loan program. But given the way the market is, and there's a whole spiel I can go in about rate compression, about why they're not opening the rate sheet and stuff like that. I won't bore you with those details, but it's basically that 7125 rate that I mentioned is kind of the sweet spot, I call it, in the market.
Okay.
There's going to be a buy down because, like I said, rate compression, they're not allowing us to get to higher interest rates. So I can't even reach a par rate, which means there's no buy down. And we'll talk about buy downs a little bit, I'm
Right,
sure.
right.
So I'm seeing that being the most bang for your buck to purchase that interest rate
Okay.
around 7125.
Okay. Is there a sweet spot for a down payment amount?
It is very situational.
Okay.
It's going to depend on the specific buyer,
Okay.
the loan program, how much they have saved, if they plan on renovating. So that's something that I go through in my pre-approval process.
Got it. So, again, going back to it's your own personal thing.
Yeah.
I know it surprised me earlier in the year when I had a lender say that for probably a particular buyer or just a generality, that a 5% down payment was actually giving a better rate than more of a down payment.
Yeah.
And
It can be a
so
little
that took
confusing.
me by
Yes.
surprise.
Mhm.
And
Mhm.
so now that's one of my questions that I'm using with my buyers.
What's the actual rate?
What is
Right.
the actual rate, and is it better for me to put more or less down?
Yeah.
Right? Is
Yeah.
something I would have never thought. I
Mhm.
always assume the more you put down, the better the rate, but they're like not necessarily, and especially when interest rates are low.
Yeah.
Correct.
There are different things that affect that apparently.
Yeah.
So many. And the secondary market is the one dictating all of that. So they're
Got
kind
it.
of deciding where they place the most value, and that's
Yeah.
where the best interest rate is going to be.
Got it. And by secondary market, it's
Mhm.
because a lot of loans are initiated and then sold. Correct.
Mhm.
So we've got a lot of buyers out there really trepidatious about the shifting in the
Yeah.
market, and they're scared. They feel
Yeah.
like we're headed into another mortgage crisis.
Yes.
Industry experts, if you read, they say that this is not the same. Can you speak a little bit to why this isn't the same?
Yeah, absolutely. First of all, like you said before, the sky is not falling.
Yes, no, it's not.
It's not the end of the world.
So pretty today.
It is. It's beautiful outside.
Gosh, we've had a great couple of weeks too.
It's been amazing. Tons of outside activity.
Yeah.
But no, I mean, when it comes to the market, so a lot of people, the most recent one was 2008. That
Mhm.
was the last housing
Right.
crash.
Yeah.
There's so many differences between that one and this time period we're in now that it's not even on my radar of another housing recession. Because we, as loan officers and lenders, we have so many more guidelines that we have to follow, and we have to qualify these buyers to make sure that they can afford the house and continue to afford the house. So our biggest job is to make sure they have the ability to repay the mortgage.
Got it.
So those guidelines have shifted as a result of the 2008 market, and we haven't necessarily loosened any of that.
No, if
That's
anything, we've
pretty
tightened
well.
them.
Very good.
Yeah,
Okay.
so debt to income ratios got tightened during the pandemic.
it.
Credit scores got tightened, all of that stuff, because it was such a volatile market.
Right, right.
So, and then the other thing to think about is when it comes to this market, every expert that I'm reading about and talking to and, getting those industry insights, every single one of them says rates are going to come back down. It's just a matter of when.
Okay.
So some people that are super aggressive are like January, February, and I think that's a little too soon in my
Okay.
opinion.
Okay.
But towards the end of next year,
You feel like-
I feel like things are gonna come back down because, the Fed is doing what it has to do to fight inflation, and that they're making it more expensive to spend money.
Right,
is more
right.
or less what's happening.
Which, that's the same conversation that Chris and I have with our clients.
Yeah.
Because although the rates are climbing, the housing inflation has leveled itself off.
Mhm.
Right.
And it was getting to
Right.
these astronomical pricing and affordability. These first-time home buyers, for one, couldn't afford to buy homes anymore.
No.
And with the rising rates, this really has helped to put things back in check and balance.
Yes.
Absolutely.
Yeah.
Big time. And when it comes to, you kind of mentioned like buyers and sellers are scared right now.
Yeah.
Because they're afraid they're going to be upside down on their mortgages
Right.
or the rates are too high. It's a great time to buy or sell if you're ready to buy or sell.
That's
You hear that?
that is what we keep
Yes.
saying.
Yes.
Yes.
Situationally, your circumstances are what they are, and there are always going to be shifts in the market, right?
Right.
So it's just about these shifting and changing strategies. So really, as we hone in on that, let's talk a little bit about some of those strategies, the things that we had seen, like for example, the appraisal gaps. That was a
Oh,
strategy of the
exactly.
last couple of years, which obviously we're not employing anymore, right?
Correct.
Thankfully, right? But really, it wasn't a good positive thing for the industry.
You know, think of a
necessarily.
contract that we would write with a buyer in May. I never did it. I never waived an inspection, but people were waiving inspections. I did have clients who covered appraisal gaps if
Mhm.
necessary. So, you know, big down payments because they wanted to get a home, covering
Cash.
an appraisal gap, trying to find cash really, and
Offering
conventional.
$50,000 over
Mhm.
list.
Consistently.
Yeah.
Yeah.
Consistently, and even more so. And now we're backing down a little bit.
Yeah. So those were things that we had to do, or we felt like we needed to shift into, right, to get buyers into homes. And now we're shifting into a different era. So tell
Yeah.
us a little bit about some of those new strategies, or they're not really new, but
No,
they're
it's just
just
going back to normal.
good way to
So
put it.
nice.
I know when I said new, I'm like, wait a minute, this isn't new.
Yeah.
Like what we just came from.
We
was
always
new.
have a strategy.
We've always
It's
had a
when's the right time and the right situation
Yeah.
to use.
Yeah.
It's dictated by the market.
Exactly.
Precisely.
Yeah, and
So,
yeah,
What are you saying?
all those things that you listed during like the past 2 years, the appraisal gap coverage, all that stuff has thankfully gone away. You know, are there still
Thank you.
multiple offers? Yes,
Mhm.
because we're still in a housing shortage. There's an inventory shortage
Yeah.
that's probably going to continue to like 2035 roughly, based off of the
Wow,
statistics
that's
I'm
a
seeing.
long time that's
I know.
going to
Wow.
take place.
Yeah.
Because the builders kind of, they
Yeah.
were on the upswing of building stuff, and then the pandemic hit, and then they weren't able to get supplies to build,
Right.
so now they've backed down.
That was the
So
conversation
we just had this
Yep.
conversation before you came
Yeah.
in.
Yeah.
So that's going to be an issue for the foreseeable future.
Got it.
So what we're kind of doing to, deal with the new market that we're in is getting back to normal. Like we said, we are now able to offer, maybe at list or potentially under list if it's been sitting. We're able to negotiate in seller paid closing costs, which
Okay.
weren't even, if you had those, they
I'm
just tossed your
starting to
offer
see
out.
that. I know. Yeah.
Yeah, and I'll touch more on that in a little bit because they're actually required by us for compliance guidelines and stuff like that. But I'll go into that in a second. We are, you no longer have to waive your inspections, which is huge. You're buying, potentially the most expensive purchase of your life, and you don't know if it's got a good foundation.
Right.
For
So
sure.
that's scary. Appraisal gap coverage, you now don't have to worry about that.
Mhm.
Typically, you can just write the offer and know that what you're paying for the house is what it's worth. You're not automatically, in a bad equity position or having to come up with a ton of cash.
Right.
So all those strategies, that you can now negotiate and, talk about different down payments and things like that is kind of what I'm coaching my buyers on,
Okay.
as far as, why it's a great time to buy, because sure, your rate's a little bit higher, but you now, let's just go back. So let's say a year and a half ago or a year ago, you write an offer, you're $50,000 over, no inspection, you've got $10,000 in appraisal gap coverage, and there's no seller paid closing costs. You get the house. Cool. You
Right.
found the house. That's what you had to do in that market. Right.
Celebrate.
And you also had to give away your first, naming
Yeah,
rights to your child.
I know.
But,
Naming right.
right.
That's neither here nor there.
Yeah, But so that's great. That's what we had to do in that market. But now take it back a level, same house, you're offering at list. So that's automatically saving you $50,000 in offer in loan amount. You now can get, let's call it $3,000 in seller paid closing costs. So that can either go towards getting a lower rate, it can
Right.
go toward not money out of pocket, things like that. And the house is sound, and you're also paying for what it's worth.
Right.
So between not offering as much money and having those seller paid closing costs, your higher interest rate payment is almost lower than if you compare it monetarily to the other offer, because your loan amount is $50,000 higher. Sure, your rate's lower, but you also had to come out of pocket for appraisal gap coverage. So that's $10,000.
Right.
That
Yeah.
covers your first 2 years of your mortgage. By then, rates are going to hopefully come back down. We're going to refinance you out of that mortgage and into the current rates.
That sounds like a great plan.
It does sound like a great.
Marry the house, date the rate.
I love that. Love that. So you brought up a good thought, and that is, you buy your house now, you're at the rate it is today. If rates go down, you refinance.
Yeah.
So I recently met with a first-time home buyer, and that was actually the concept they didn't understand, was the whole refinance. So are there like penalties or costs if you're doing that, if you're refinancing?
No, there are no penalties.
They were like, just how does it work? And,
right.
you know,
So, more or less, the way to put it is that we pay off your current mortgage and we put you into a new one,
Right.
and we get all the new rates and terms and all that stuff, in the current
Mhm.
market. As far as penalties, there are none. Fees, yes, there are still lending fees.
Right.
Yes, there are still title fees. But the great part of a refinance is, as long as you're in a decent enough equity position, we roll all those costs into the loan. So yes, your
Okay.
loan amount's going to go up a little bit, but you're not coming out of pocket.
Okay.
Worst case scenario, you have to pay for an appraisal, and that's
Right.
it. So
Mhm.
everything else is rolled in, so you don't have to worry about that. And the other, comforting piece of this is we can't just refinance for fun, like, because you're going to save $20. That's not enough of a tangible benefit.
Right.
Like, there's people
Yeah.
out there that might take advantage of that.
Right.
We have rules in place to kind of go back to the difference between 2008 and now,
Got it.
that we have to have a net tangible benefit to you as the consumer to be
Got
able
it.
to either, go from a 30 to a 15 year, or
Okay.
go from an
Okay.
FHA to a conventional loan to get rid of
Right.
PMI,
Right.
Okay.
or just get rid of PMI because you're in a better equity position. in your
Right.
house. So there has to be a good reason, and it doesn't cost much to use the consumer.
Interesting. And
Yeah.
I wasn't aware of that. So
Mhm.
that's very
I wasn't
interesting.
aware of that either.
Yeah.
That's
Yeah.
good to know.
And I was always under the impression that a good rule of thumb is a percentage point. So like if mortgage wise, you're at a 7% and it goes to 6, that's when it's the right time to consider.
1 percentage point. is
One
what you're saying.
percentage
Yeah.
point
Correct.
makes it worth your while. Is
It-
that still true?
It's going to depend on the situation.
Okay.
It's too much. There's like, it could be, if it's a smaller loan amount,
Mhm.
that 1 percentage point on like $100,000 loan is not going to impact you as much as a $400,000 loan,
Got it.
or maybe
Yeah,
a
that
half
makes
percent
sense.
makes
Sure.
sense.
Okay.
Yeah.
But it could be maybe the rate's going to stay the same, but you have an FHA loan and you're switching to a conventional loan. You're at 80% loan to value, and
Yeah.
the mortgage insurance is gone. That could potentially save you $150 a month.
Right.
Yeah.
Right.
So it's situational, but that's something, again, going back to, I can't just do it for fun. I'm going to look at the situation, pull your credit, set up the file, and say, hey, this is how much you can save. Is this beneficial to you?
Got it.
And then they decide.
You make some really great points, and as you're coaching your clients, and Chris and I are having these same conversations, the rate is what the rate is, but when you look at the flattening out of the housing prices, and you look at all of these exponents that you had to buy into, the appraisal gap and everything else, it makes a lot of sense, I think, for the buyer to realize that there are a lot of good reasons to buy
Yeah.
right
Right.
now. Right.
Exactly.
Definitely.
Exactly. Are you seeing like you guys deal primarily in conventional loans, correct?
Oh, no, we do them all. FHA, USDA.
So are you
yeah.
seeing some?
Of
Okay,
that
that's
come
what I
back,
thought. I
yeah,
know the
'cause-
other is your sweet,
yeah.
maybe a sweet spot or something.
Yeah,
but,
I'm dealing with like a VA right now, whereas I don't know, they could go conventional, but it wasn't, that type of a loan may not have been looked at, in the
Right.
last 6 months.
Yeah.
But
so
now
are
it's
there
shifting.
advantages of maybe thinking outside the conventional world at this point? And
Absolutely.
that you're seeing?
Absolutely. One, you don't have to be cash or conventional to buy a house anymore, which is
Yeah.
great. We can now,
And I think that's why our train of thought
Yeah.
goes there.
yeah, absolutely. So now I'm actually reaching out to all my FHA, VA, USDA buyers that
Mhm.
couldn't find a house because their offers weren't even getting
Yes.
considered.
Yeah,
And they're getting back in the market, and they're finding a lot of success right now. So
100%.
each program is specific and beneficial in their own way. So
Right.
FHA is for somebody with maybe less than perfect credit or less of a down payment available. VA is, in my opinion, one of the strongest loan programs. You have to be a veteran to be able to apply for it. And it's 0% down.
Yeah.
I mean, the
Mhm.
mortgage insurance is negligible. It is super strong, and you can continue to reuse it after you sell. So that's a great one. USDA is another really, really strong program.
Right.
Granted, it's got to be out in the
Yeah,
sticks.
you've gotta be
because-
eligible.
yeah.
Not as far out as you think.
No.
I'm
No,
always surprised
Yeah,
when I'm
same.
like in Harrison and I've had
Mhm.
ones
Yeah.
there qualify.
Well, if you look at the USDA eligibility map, it's like time zones. It's just kind of zigzagging in weird
It's very
spots. It's getting
zigzaggy.
updated all the time. So yeah, but that's another good one. But yeah, so these like offers are getting considered now, and it's opening up a lot more buyers into the market because they got so discouraged over the past 2 years.
Right.
And
Yeah.
I'm
that's-
seeing a lot of success with it.
Talk to us a little bit about locking in your rate.
Mhm.
Today you said that you feel like they're going to consistently go up and then flatten out, but that may take several months or
Right.
a year to actually
Wish I
happen,
knew.
right? Yeah, crystal ball, right?
Yeah.
Tell us about that, locking in your rate right now.
Right.
How does that work, and is that beneficial?
Yes. So we at Rapid Mortgage do not lock a rate in until we're under contract.
Got it.
Okay.
So that, we do that for a couple of reasons. If there are places that do, sometimes it makes sense. I would just make sure you read the fine print, because there's a lot of adjustments that happen and
Mhm.
costs that come up associated with
Okay.
that. So just make sure you ask the right
Mhm.
questions. But when it comes to locking the rate, like I said, we're under contract. I call the consumer and say, hey, Mr. and Mrs. Buyer, we are ready to lock your rate in. And I will pull up, the active pricing, see where rates are that day, and we'll kind of talk about it. And then, we'll talk about the buy downs, we'll talk about the points, we'll talk about all that fun stuff. And then once it comes down, I kind of explain it this way. I am we're gambling here.
Mhm.
Some people want to float because they think the market's going to get better. Some people want to lock in because,
Yeah.
the devil is the best devil to have.
Takes all kinds to make the world
Exactly.
go around, right?
Yeah.
Yeah. So the way I tell them is like, all right, do you want to lock today? This is where it is. This is my feeling on it. I don't know where rates are going to go. I tried to predict that, and
Mhm.
it's just not worth it because I don't know.
Mhm.
So I just say, I'm the one pulling the lever. You just have to tell me when to pull it.
Okay.
So, and then we lock that rate in, and we can lock for 30, 60, 90, 45 days to be able to fit the contract dates. Or
Got it.
whatever.
Got it.
And then
Okay.
that's fixed for 30 years.
Okay.
So you just mentioned a buy down.
Mhm.
Yes.
And I've seen, I'll be honest, I'm getting a lot of information about little workshops. And one of them that I've seen a couple of times now is come learn about 2-1 buy downs or buy
Mhm.
downs. What are those and how does that work?
Sure. So points, buy downs, discounts, all the same thing. And it
Okay.
is essentially a monetary cost, which is going to be a percentage of the loan amount to purchase the interest rate at that
Right.
level. All right.
Okay.
Before we go into the 2-1 buy downs and all that stuff, buy downs are becoming necessary in our world, lending world, because we have rules and regulations on how much we can charge the buyer as loan fees go.
Okay.
So processing and underwriting fees, appraisal fees, stuff like that, that's considered a certain type of fee that we can only charge up to 3%.
Standard amount. Okay.
Exactly. So it's 3%. And these buy downs are, normally back in the day were, around a point. That's normal. That's
Mhm.
fine. We can
Okay.
still have that and the buyer can pay for it. Now
Mhm.
these points, just to get to that 7.125 rate, are almost 2 points. So that just leaves us 1% to fit in all these other fees. If we can't, we're then in a high cost loan and we can't close the loan. It is not compliant, doesn't fit the guidelines. So that's why we have to get seller paid closing costs
Okay.
for somebody who is in that situation, because we are able to then move some of those costs to the seller side, and then we're still within that 3% limit charged to the buyer. So that's a conversation I'm
Got
having with
it.
my agents,
Yeah.
both listing and buying.
Yeah.
agents.
It affects both sides.
Right. And
Okay.
that's why seller paid closing costs are not really, a weakness in the buyer.
Right.
It's just a guideline we have to follow as a lender.
Mhm.
So I'm just making sure that everybody understands that it's not because we need the money. It's because we have to, we don't need the money because they don't have enough cash. We need the money because we need to fit the
To make
guidelines.
it
A
compliant.
certain, right,
Exactly.
regulatory compliant.
Yeah.
Yeah.
So that's the main thing on those. And I'm trying to explain that to everybody I can. Doesn't matter if I'm on the deal or not, because it's becoming industry norm.
Well, you make a good point, because it does, we've really focused on how the shift in the market affects the buyers and the rates and such, but it really affects the buying and the selling all around,
Right.
the buyers and the sellers.
Definitely.
So we need to, have those conversations too.
Which is true,
Yeah,
right?
yeah.
And we assume when we're talking lending, we're talking buyers. But Dena, my question for you is, again, can you go into a little bit more about why this is important to
Oh, she's gonna put me on the spot now.
Yeah, absolutely. Wow.
Thank you. I thought this was all about the Adam Show today.
The Adam Show. Like,
I think really most importantly, first and foremost, it's about having those conversations with our sellers as well as our buyers, but our sellers also about expectations. Expectations maybe as far as days on market, right? If we're going from 0 days on market to, maybe 7 days, maybe 14 days, maybe 30 days, maybe 45 days. So setting those expectations up front, I think, is really critical. And then to your point about the contract and what we may see, what that seller may see on a purchase contract is going to be different than what it was, in terms of what they may have heard was happening 3 months ago, 6 months ago, 12 months ago. So yeah, it's really important, I think, to set those expectations up for them.
I agree.
Because it's kind of a smack in the face when they are used to, hearing at least about something, something else happening, right?
You have to deal with the sellers wanting to say like, oh, my house has been on the market for 2 days and I don't have an over list. I'm over here like my buyer's like, why isn't my rate 3%? So and same ideas, different conversations.
Exactly. And we remember, Dena and I both have been in the business for quite a while. We remember when listing contracts went from 6 months to a year because it was taking a year to get a house sold. And, and my heart goes out to people because we're in that transition. It's always more, I think it's always harder when you're in that transition. I'm going to take it how it affects sellers just even a step further. I'm actually seeing it as part of seller marketing of, hey, sellers willing to pay closing costs. I saw one this morning, seller financing, right, which we haven't seen in a long while. Assumable loan at, someone this morning, assumable loan at 2.36%.
Wow.
And so, we haven't seen assumable loans like since I've been in the business, but if somebody's got a 2.36 mortgage and
they're able to do that.
And I'll be honest, I don't understand how those quite work. I know just the gist. I know the gist of it. But as a marketing tool and a seller saying you can help with this, you're up front, you're going to help with closing costs.
Right. And that's a huge thing. And you as agents can put those in the comments on your listings on the MLS. The 2-1 buy down is a great example of that.
Yes.
It has to be seller funded. So putting that in before you do a price reduction, that 2-1 buy down is actually going to save the buyer way more money over time compared to a $10,000 price reduction. So a 2-1 buy down is essentially, we're going to qualify you at the current rate. Let's just call it 7%. But we close on the loan. The first year of the mortgage, your rate's going to be 5.
Okay.
The second year, it's going to go up to 6. And then the third year, it finally goes to that final rate, and that'll be the duration of the loan. So that's a 2-1 buy down, seller funded, great marketing tool for listing agents.
Great marketing tool, great strategy, right? Which is what we're talking about today.
Great strategy. Kind of to bring it on.
Absolutely. And those assumable loans, like you said, they weren't even they haven't been around in forever. I talked to the owner of Rapid this morning on the drive here just to kind of ask him some questions because I've never done one.
Right.
He's like, in my 20 however years he's been in the industry, he was like, I've never been privy to one ever going through.
Me either.
No. So the reason is because it leaves the seller actually open to a lot of problems.
Got it.
So they're not responsible for the mortgage, but if there's a late on the mortgage, that affects the seller's credit. It could be 10 years down the road.
Interesting.
Yeah. So it leaves them open. And then specifically, it can only work for FHA, VA, USDA.
Okay.
And if it's FHA, then that seller cannot get another FHA loan because they already have one technically. And then the VA can't reuse their benefit until that one's paid off.
So attractive to the buyer, but not necessarily
to the seller.
So definitely a lot of questions need to be asked. Should that be brought up?
And then there's the whole lending side of it, that it has to stay with the current servicer. The current servicer has to be okay with it. So there's a lot of qualifications.
Then you have to borrow the difference, right?
Correct.
So
you're assuming everything.
The current loan's only $100,000. This is a $400,000 home. You still have to make up that $300,000 somewhere.
Right.
It's not like they bump it up to the purchase price.
Right.
That part I do know.
So there's a lot of nuances to that one.
There are a lot of nuances. Is there anything that we haven't quite touched on as far as what's happening in today's market, or any type of strategy that,
Honestly, you guys nailed it.
That's
I was really kidding. Yeah, no, you guys, I mean, it's awesome. And getting this information out there is so important.
Yes, it is. So what is your prediction? Again, you seem to have
Get out your crystal ball.
Yeah, exactly.
Disclaimer, I do not say that this is true and will be happening, but in my opinion.
Yeah, what is your prediction for the future?
I think we're going to hopefully see a level off. There was this whole CPI chart and graph that basically there was one outlier left and that has now fallen off. So I'm hoping we plateau for a little while. I think the Fed's going to still do what they have to do to fight inflation. Basically, the goal is to get that, MBS number or the Fed rate past inflation, because that's how we're going to fight it. So I think rates are going to continue to go up for a little bit, but not much longer, maybe flatten out. And then towards maybe this time next year, I'm hoping and kind of reading that we're going to be back down, hopefully 5.5-ish area, something like that.
That's
is what we're
that's a
thinking.
that's a nice rate, right?
But here's the thing, 7% is the average rate since rates
Right.
have been.
Oh,
Right.
yes.
I mean, that
Yes,
was
exactly.
that was my first mortgage,
Yeah.
was at a 7% rate. And it's funny how, you get so far away from that, you think, coming back to it, people are like, oh my God, just
Yeah.
because we were at 2.5,
Well,
right?
a lot
But
of people have never experienced
but
it.
a lot of people haven't
Right.
experienced it.
Right,
Yeah.
that is true.
That does make a big difference.
Yeah.
Adam, give us your 30-second commercial, or what is the benefit of using you in Rapid Mortgage?
Sure. So I'll do just my elevator pitch. 'Cause
All
I
right.
don't have a lot of time, but Adam Rapid Mortgage, your locally owned and operated mortgage company. My office is in Anderson, corporates in Blue Ash. Everything we do is from start to finish is by a Rapid employee, which makes us flexible. We can close a loan in 21 days. And the X factor is that nobody else is me. So I give out my cell phone number to all of my buyers, all of my real estate agents. Make sure that the buyer is really comfortable with the numbers, make sure the agent knows what everybody's pre-approved for. And then also, whenever we're writing offers, I am calling the listing agent to vouch for our financing. I'm doing an address specific pre-approval letter, fully underwritten, fully pre-approved, which allows us to do that 21-day close. And I'm also doing a custom video that the agents can attach to the offer.
Very nice. I love that. The communication,
The human factor.
for us,
Yeah.
the agent, the communication is key, both with the client and obviously with the agents.
Oh my goodness.
Because
yes.
a lot of lenders, forget that element a little bit, right? So
Yeah.
we're the ones chasing,
Yep.
right? Trying to get information.
Absolutely.
So if you're bringing that to us, it makes our jobs easier, right?
It
we're
does,
all
and
on
it
the same
benefits
page.
our
Benefits
buyers
the-
both as a buyer and a seller.
The
It
bottom
benefits
line,
our
yep,
clients.
bottom line is our mutual clients, right?
Yeah. And it's
And-
communication. I mean,
Yep.
Yeah.
the other thing that I do is Wednesday updates. So I talk to my processor every Wednesday, get an update on all my active files, and then I call the listing agent, the buyer's agent, and the buyer. So everybody knows what's going on.
And
Awesome.
we've already talked about
Yeah.
this because every Wednesday I reach out to my title companies, my lenders, my clients.
Wednesday's the day.
Well, because Tuesday things happen, right? And
Yes.
so by Wednesday,
Yeah.
that information or things have been processed.
Yeah.
There's a lot of closings on Fridays. So,
Wednesday's a good
you're
day.
kind of that good in between of, we wrapped up last week's closings, we're getting into this week's
Yeah.
closings. So,
Definitely.
what's the best way for
Yeah,
people to
how do
reach you?
people reach you?
So, like I said, my cell phone number, 724-312-8100, or my office line is 513-769-2043. I have a Facebook page. I'm on LinkedIn. Don't do TikTok or, Instagram. I should, but I don't. But those are the best way. Look me up on Facebook. I have a lot of videos about, mortgage tips and things like that as well.
Of course, you can
Perfect.
contact Chris or I to
Yes.
get in touch with Adam as well, and we are happy to bring that information to them.
Absolutely. That's the best way. You guys talk about it.
Yeah.
Well, thank you. Yeah. And if you are one of our YouTube watchers, there will be a slide at the end of our show with Adam's contact information. But
Yes.
contact us when we can help.
Yeah. So thank you, Adam. Thank you for
Yes.
joining us today. Both our house and home chat and our real estate real talk portion go hand in hand today, and we're giving that small business shout out to Rapid Mortgage and Adam Brewer.
Thank you so much for having me. It was a pleasure.
Well, thanks.
Thanks for
Thanks
joining us.
us today on House and Home Chat, Real Estate Real Talk with Dena and Chris.
Thank you.
See ya.
Bye.